Hey, I'm Jan VanEck, CEO of VanEck Funds. Long term, I'm panicked about our debt levels, Howard.
Knut!
Hello, Howard.
Hello! Our guest today, funny guy. Funny, haha, and funny peculiar. I'm going to get right to it. He's a Dutchman. Was a Dutch descendant. And it's weird that we're friends because he's well-educated and he's super smart. Well, yeah, well-educated. So generally, I only hang with people at ASU or below. But my friend Jan VanEck, who I've been dying. Yeah, but you were always smarter. You were always doing the work, and I was in the back row copying it. So I'm really excited today, as I've done since the break. I'm having a lot more of my friends on, people I like talking about markets with. We're at this really weird. I don't know. We're going to talk about with VanEck, but this really weird moment in global markets. Deglobalization, rising interest rates, mortgage rates at 7%. The VIX, which has been over 30 for like most of the year, is actually dropping. It's in the 20s. And I personally am in a lucky position where I don't really have to be in the markets, but because I'm fascinated by them and started Stocktwits and love talking about them and want to continue to, try and bang out some alpha, this has been the most interesting year, even though it's been one of my worst years at like trying to figure things out. So I wanted to have a bunch of friends on as we came back from holidays here and getting Jan on to talk about debt, to talk about the ETF business, talk about money flows, and Jan also very early, not the earliest, but early enough in directionally putting the firm on a path towards crypto. He has a lot of insights there as well. And I think the firm, he'll confirm, I think it's, $70-80 billion, the VanEck family of ETFs. Jan, so he doesn't have to go through it, Knut, is the CEO of VanEck, and their New York headquartered mutual fund and ETF company. He joined the firm in 1992 and the executive management team in 98. It's his father who started the firm back, I think, in the 50s. And Jan founded the firm's ETF business, which is a great move in 2006. And now they're one of the world's largest ETF sponsors. And VanEck offers ETFs globally across a variety of equity and fixed income assets. And I think one of the most interesting things about VanEck is a great family guy, and we laugh about our kids, and his kids are doing great. And we laugh about so much stuff. We met through another friend who we've had on the show. Mm-hmm. Oh my God, I'm having a fucking senior moment, Knut. But Jan will remember. But we sat down at dinner, and we're not supposed to be friends. VanEck's supposed to look down at guys like me. But he gets the joke. And for me, it's always fun being friends with much smarter people who do more important things and have really great businesses. So let's get Jan on the phone. Are you good with that?
Absolutely.
All right. Jan, is this Jan or just some other Dutch guy calling in for a Jan?
It's Jan. It's the real Jan this time.
So why would you agree to doing this? I know, it's impossible that this is a good decision. So what is it about? Seeing that it's a bad decision, why, Jan? Why?
No, this is really exciting, Howard. It's great to chat with you about the markets. I can't. I don't know if you remember this. I haven't seen you in a long time.
Yeah, this has been the longest time. But
Knut, in March of this year, Howard was kind enough to speak at one of our investor meetings in Miami during Bitcoin 2022.
Oh, great!
And he talked about, for me, the business issue was you go from 0 to 1, right? How do you get product market fit? But then the tough question as well is how do you grow into a mature business and go from 1 to 2? And that's what Howard was talking about at lunch. And I just remember, it's like, just to be very clear, everyone, I interjected. I said, you're talking to Mr. Cash and Mr. Cash.
Yeah.
Because we were bearish.
Yeah.
And we can talk about whether your opinions and mine have changed, Howard, but I think that's one of my highlights of the year, because I think that it was hard. People are always itching to get back into the markets, but I really remember that.
I didn't have enough. I'll tell you my story because a lot of people follow me. I went very negative because, you're an LP, and we'll get into some of the stuff because I'd like people to know a little bit about how you make investing decisions and how you chose us and Smart or Dumb, and really walk through what you like about, investing with us in this type of category, because you are a swashbuckler and risk, and you love risk. So, you and I, to see the same page on cash was interesting, but my cashing was just like, what a run. And my cash decision was driven basically by my private decisions. Seeing prices that I was not willing to do at the seed stage is one thing, but then seeing those prices even at the public markets and saying, I know I can get out of them, but why am I in them? And so I started reducing. I think my biggest mistake is I reduced to maybe 70% of because I'm a momentum and I owned all tech stocks, but that 30% that I held, or 40 or 50 that became 30, has been ugly. So I'm still having, in terms of pure equities, it's still the worst year I've had. And it comes at the end of a long run. And I feel bad because even though I'm, 20 to 30% long, tech stocks right now, the point to get there still costs me 20%.
Knut?
Yes.
Can you tell him to stop beating himself up on this point?
No, I'm not.
Yeah.
I'm just saying how I got there was not like an epiphany to go to 100% cash. So I'd never seen anything like this.
You mean you didn't nail it 100%?
Yeah, I definitely didn't nail it.
Wow.
No. Good point. But I haven't said this on the podcast. But it has bugged me. And this is what the investment business does to you, is what was I thinking? All the signals were there. Me doing a SPAC. I remember in the meetings raising the money for the SPAC going, well, every time I hung up from a call, I would have maximum dollars allocated. And I go, and I'm in my underwear, and I'm like, this has to be the top. And this was March 2020. So what was it for you, Jan, that just when we talked in March, when we both collided on cash, what were you thinking about?
Well, not to make your listeners hate me any more than they do, but, I'm really kind of into history, and I teach it to our interns, and I'm going to probably bring it up a couple of times. But one of the things that history does to me is give me higher conviction about, who knows what's going to happen in the future, and there should be a whole bunch of different scenarios in your mind about what can happen. But when I was looking at actually a chart of railroad stock prices, they collapsed even as the railroads were being built. It was just kind of one of the first disruptive technologies, and I won't bore everyone with that. But when I saw how far the stocks could fall, even for something that ended up being super important to American commerce, then I realized this is going to be true for every disruptive technology, and maybe the dream of crypto is in front of us, but boy, can prices crash before then. And then you just extrapolate from crypto to growth. And so the same dynamic was basically, it was the other phrase, and you mentioned one of our kids, words would come out of his mouth, Howard, 40 times revenue.
Yeah.
That's a great valuation. I think words like that should not be strung together in the English language.
Right. And he's well-educated.
That's just insane.
Smart. Yeah.
He's a good investor. He's a really good investor, but it wasn't him saying it. It was just the era, right?
No, and I say this, Jan, today because you've been in. How did we meet? Do you remember what's his name? It was Savneet.
Savneet Singh,
and great networker.
And you don't really know this, but I kind of fell in love with business in Silicon Valley a long time ago, and you had a kind of a founders dinner here in Midtown New York somewhere. And that's how we met. Savneet and I were talking about a startup idea, and he brought me along, and it was just magic. It was just so fun. It was fun, Knut, as you can imagine, but it was also fun just, hashing out, brainstorming new business ideas, and having early stage entrepreneurs try to figure the world out. So it was love at first sight.
Now what? Yeah, yeah.
Not to make you uncomfortable.
Well, it wasn't your hand. It was love, but not physical love. So what is it about tech? So that, let me just go back to the railroad thing. Absolutely. Even today, railroads, like think about the bubble that happened in railroads, how many there were, just like, the WorldCom, Quest, telecom explosion in the late 90s. If you go back and look at those charts, railroads up until recently were back at all-time highs, right? They're now in their next correction. So yeah, I mean, you're not like me looking to put cash back to work because the long-term direction is something, but I think you're saying history just kind of reminded you that, tech can, or whatever it is that's moving the world forward, can just go through some horrific periods.
Yeah, it's hard to know what's going to happen in the future, but sometimes like it'll click. And look, for a lot of people, it was the internet bubble. They were like, I remember the internet bubble. And so they got the trade right like you did. But, it can just get you more comfortable with a particular opinion. Because again, none of us really know. And then not only do we not know what's going to happen, we don't know what's priced into the market, right? So we have two levels of utter confusion.
So as a student of history, here we are in late 2022. Fed's been raising. I don't want to argue about what they did wrong or right for the last 20 years. They're raising right now. And people haven't seen this. So people ask me what I think, and I go, I'm 57, but I haven't seen this. And, we went through 2 years of people blaming Citadel and Robinhood, and God bless, everybody's, they're not clean. But if you're a Schwab customer and you've been in a 60-40 portfolio and allocating that for the last 4 years, more money has been lost by Schwab clients in bonds, assuming, it's on paper. But the amount of money lost in the bond market this year, just is mind-boggling. So
it's staggering, yeah.
So combine that with debt. Where are we at? Like what, you said you panicked a little bit about debts. Where are we? And where is your head when you were cash VanEck in March to where we are today in November, where we know where rates are? Mortgages are 7%. The Fed's still saying they may be looking at the wrong data, so they're probably still going to raise rates. And you have deglobalization and record debt levels. What are you thinking about that with a historical lens?
Yeah, well, you triggered me with your 60-40 portfolio. So just to level set, I kind of think of myself as like a macro, I know this is going to sound really stupid, but macro structuralist. Mm-hmm. So what I mean by macro, though, is that the financial markets are just a reflection of what's happening in the world. And what's happening in the world is economics, politics, and technology. And so you can have major developments in the world, and that really should get you to think about what asset classes do I want to be invested in. That's how I think about it. So let me explain. So, one of the areas that we got involved in was the emerging markets, and I traveled to Hong Kong in 1992, said, oh my goodness, what's going on here? China's developing. Like I'm hearing all this great buzz about how business is booming in China. So I traveled there a couple of times. Emerging markets wasn't even an asset class back then, Howard. China didn't even have stock markets, right? So that to get that play, maybe you bought a basket of Hong Kong stocks. Now, maybe we're at the other end of that. Like, is emerging markets really an asset class? So the world reflects that. Going back to 60-40, like that's no magic number. It's not a magic number at all. It's just an optimization at one period of time. And so, I really like bonds right now. So I'm like, why shouldn't it be 80-20?
You mean 2080?
2080, sorry.
Yeah. No, I've been borrowing 1 and 2 year T-bills and may go even further out on the spectrum because it seems like bonds may actually be a trade. I mean, I've never traded a bond, but like they feel like to happily take 5%, or maybe I'm sure there's some corporates out there at 7%. And if rates drop, I actually have it. I can't believe I'm saying that. That was like not on the spectrum of thought a year ago.
All right, so let me go on a little riff about the 1970s because Because my dad started the firm, he talked about the markets at the dinner table. So I actually kind of really feel like I experienced the 1970s. And if you look at that time period, you learn a couple of things. First of all, most people understand inflation wrong these days. Inflation isn't really about oil prices, even that's what people talk about a lot. Inflation is really when you have wages. We're a services economy. Most of our compensation is in salaries and bonuses. If you get into a wage negotiation cycle where the worker at McDonald's wants to get paid more, and then they have to raise the price of burgers, and then the people who have to buy the burgers want to get paid more so they can afford the burgers, and it's a never-ending cycle. That's the dynamic that we're in. And even last year, I said, we're not going to know about that until the second half of 2022. We have wage inflation now in the United States. If you look at services inflation, which almost no one does because whatever, it's not in the newspapers, but services inflation is in the high single digits, and that's what would worry the Fed. So the Fed needs to be higher for longer in terms of interest rates and cutting back on money supply growth. And so I think the worst thing is investors get too anxious to do something. And so, time is on your side if you're a fixed income investor. So Howard, obviously if the Fed loosens or pivots, whatever people call it, VanEck is going to have a great time because our gold funds and our commodity funds will explode and it can sit back and watch AUM grow, right? Mm-hmm. But what happens if the Fed just keeps its foot on the brake for a long period of time? So I pulled out a chart of the 70s, and what do you think did better in the 70s, stocks or bonds? It was the worst decade for inflation and bonds in U.S. history, right? Forget the last 100 years, but the last 200 years. And amazingly, bonds outperformed stocks because once you get higher interest rates, the move from 0 to 3% interest rates is super painful because of just the effective duration. But if interest rates go from 8% to 11%, it's actually a lot less painful. And then if you take the income that you get from bonds and you reinvest it, so you start the year, let's say you buy high yield now, you start the year with $100, you end the year at $108, the $100 plus income, then you reinvest the 108, right? It keeps growing. And so it's actually there are many time periods where high yield bonds have beaten equities.
Right. The thing that I have struggled with, this is why I'm trying to think through, stocks, because I only know stocks because guess what? I was born in the 60s and I bought my first stock in the late 80s or 90s. So stocks, it was just lucky, my place in time. Then you combine these, like your son entering the market where venture was the cool thing to do, which you add illiquidity to high prices. And I don't even want to start thinking about how compressed the returns could look for the last 3 years, pushed out another 7 years. But the idea that there is nothing wrong with 8%, there's nothing wrong with 5%, it's a lot better than losing 20%. So we're in this transition phase where guys like even me who've been hit over the head, even though we were right in terms of like trying to raise cash, this transition period just is so brutal. And now I'm, talking to smart people like yourself, just trying to figure out what the next 3-4 years could look like. Because now I'm more in the mindset of, okay, I preserved what I preserved. Everybody has to go through this phase. You preserve what you preserve. You can't beat yourself up over it. I mean, you're welcome to, but it's really not productive. And then you have to start thinking about, like you said, what could the next, do we look more like the 70s or 80s, or do we get back to the, what period do we look like? What's your gut feeling so far based on like the data that you're seeing? And obviously debt, you said, is something you panic about. So what's your gut feeling?
Look, a lot of it just depends on the Fed, right? Does the Fed pivot? If it pivots, then financial assets will rip again. Uh-huh. And they're kind of playing with us now, right? But yeah. I really think my base case is that the Fed will have to be tighter for longer. Mm-hmm. They really, to get inflation psychology out of the system, and I really think they're looking at the history books, that they have to be tight for, at least 12 months from here, right? I mean, I don't see how they can start loosening up. And I know that's what everyone on Wall Street's waiting for. I'm like, why are you waiting for that? I have two stories for you from the 1970s. Because, what I think is everyone asking the wrong question. Like they're asking, when are equities going to rally? I'm like, stop asking that. That in the 70s, like people got so sick of stocks, Howard.
Yeah.
So I'll give you two 70s stories. We had a sales guy who was talking to me when he was a retail broker in the 1970s, and stocks went down almost every day, right, for years on end. So they got really bored in an afternoon, kind of like the three of us could, sitting around, and they said, let's see if we can give stock away. So they had an office competition to give away 50 shares of General Electric. Guess what? They couldn't.
Yeah.
4 o'clock rolled around, and clients would either not answer the phone once they heard who you were, right, or hung up, or they would just say, no, I really just don't want it. And that's story number one. Story number two is that in order to cut costs, this is old-time technology, Merrill Lynch had installed touch-tone phones.
Mm-hmm.
They had to cut costs. They went back to rotary dial phones in the 70s.
Lord.
So I don't know. It's
Can you
just,
imagine what these millennials would do if you took away their laptop, their fresh Apple laptop?
You slowed down their Wi-Fi, right?
Yeah.
I don't know what the analogy is, but anyway. It's just a different era of thinking entirely, and I think we're still trying to. When are the old good times of COVID gonna start again?
Yeah, I don't even see the hints of it, and here's why I don't. Is because you've been an LP of ours forever, and you've seen the pace of what we've done slow down for a couple of years, but we haven't caught up fully. But the money's still out there. It's raised. So what's different about this time is it's not like there's not money to put to work. And that's what's causing me the most confusion. It's not like you're probably not stressed about that either. It's not like the money's not out there. And then as to your wages, let me just say that the way the states are acting, our wages, there's enough states willing to relax the laws for corporations to get them to move. And I feel like low wages could persist because this country's so big. And so it's going to be weird. Certain parts of the country are going to have high wages and certain parts of the country are going to have low wages.
But our labor markets haven't loosened up. I mean, it's already November. Where are the headlines of higher unemployment rates? You're not seeing that. It's November of 2022, right? You would have thought that if the Fed stuff was kicking in, you'd start have unemployment rates start going up.
Yeah.
We have a weird labor market, right? Because of COVID too, people have just changed how they want to work and all other kinds of things. So the Fed has a lot of work in front of it.
Okay, so debt. People have been worried about the debt forever. Where's your stance on the debt thing?
Well, I mean, I'm just saying when you look out 6 to 12 months, all these governments, look, personal balance sheets are fine. Corporate balance sheets are fine because a lot of us saved money or corporations borrowed money at really low interest rates. But the federal government has been piling on debt like crazy. And I'm not the expert in this topic because, Howard, our whole careers, right, people have been talking about debt.
Yeah.
And, who knows when? It's just totally unknowable in terms of the timing. But I think it'll start being thought about a little bit more. Maybe a couple of people are tweeting about it now, but it's really going to cut into, you're talking about hundreds of billions of dollars of expense for the federal government, and there's going to be trade-offs involved. So I don't know if the debt bill starts freaking out the markets. That's not really what I'm talking about. I'm just saying, wow, that's a really, really big bill.
Yeah, it's a really big bill. And I had Ben Hunt on, and we were thinking the Fed will pivot not for what's happening in this economy, but for those big debt piles elsewhere with the strong U.S. dollar. So I think the trigger is going to come. I think they'll pivot, but they'll still have to, like you said, for the next year or longer, have to, once they pivot, get right back to it because they got to fight that bogeyman. So yeah, I think you and I are on the same page. I think we've been clear about that. It's still really time to be careful. So in running a business like yours then, where you have, a family of ETFs, first walk me through, you came up with, what was the ETF, what was the brainchild in the 90s about ETFs. What got you going down this path?
I mean, it's the same reason that we got into Bitcoin, because I thought Bitcoin might disrupt gold. So we had a gold mutual fund, run by a geologist who picked stocks. And it was the first gold fund in the United States. The super quick story is that gold was always fixed against the dollar. My dad studied under a monetarist in his 40s at night, and it freaked him out. He bought the Kool-Aid, sold all his stuff, bought gold shares, and 4 long years later, gold started going crazy and went from $35 to $800 an ounce. So anyway, got into ETFs because I said, I've got this, old mutual fund, but ETF is going to kill it. Right. And so we went to the SEC, filed. You had to do all this stuff manually with lawyers, get an application. And thank God GDX was the first gold mining ETF to market. And it just started trading like crazy because people love to trade vol. Right. And gold shares are very volatile. So, that went. And then we said, well, this is really great because it's, as a marketer, you would love it too. Right. Because all you have to do is like list it. And then people can research it digitally, and you can come up with cool ideas. So the first set of our ETFs were effectively exposure vehicles because no one had done it yet, like a Russian ETF, Egypt, agriculture shares, MOO. We came up with that ticker symbol, that kind of stuff. And then...
and you have SMH, you have the semiconductor.
Yeah, SMH, OIH. But then after picking up a bunch of like good exposure ETFs, we started getting involved in, sort of ETFs with a theory that there's an interesting way to play the market, even though there might be, let's say, a high yield ETF. We said, listen, a lot of high yield strategists have talked about fallen angels. So those are high yield bonds that actually started as investment grade, but then got downgraded. And so there's this trick where a lot of institutions have to sell them when they get downgraded, so the bonds get artificially cheap, and it's a good time to buy them. So Fallen Angel is an ETF, and then we have a wide mode ETF that we do with Morningstar Research, which is just, investing in companies that have a competitive advantage to keep a higher than average, profit stream. So those are the other kinds of ETFs that we do. And of course, we've done a couple of things in crypto, but in the US, it's super hard. So we've launched 13 crypto-related ETNs in Europe, and we have a bunch of indices. But that's about what we do.
And so where's the most interesting part of the world? You travel a lot, I travel a lot. What I believe, and I just gave a speech about this in the Caymans, that, everybody's talking about AI. You're a bit of a tech geek. I'm a geek. I feel like while we were all looking at crypto, some other cool things have happened around machine learning and AI. So we're at this like really interesting inflection point where, there's just not the next thing at scale. But, as someone, I travel a lot and I use my eyes and ears as my AI. There's just so much going on around the world, this movement of brains and access of money, the Middle East, they seem to be able to get along when it comes now to like, why am I paying 2% when I live right next to Israel? So the Arabs and the Jews are working together. Europe is in this massive transition, but there's still amazing things going on. Like what's interesting in the world? Is there any spot that's interesting in the world to you?
Long term, I think China growth is going to go down. It has started to, and they have a big demographics. Have you seen the demographics on China?
Yeah, it's bad.
They're at the inflection point, and their population is going down to 800 million in 70 years or so. It's going to be really interesting to see. But I would say no area in the world. The only space where I've been spending some time trying to get smarter is Brazil, because their regulators are super crypto friendly. They really think that they just need to tokenize their economy to cut down costs for consumers. And so they've been allowing a lot of experiments. That, who knows with the election whether that legislation will continue to move forward in Congress. But that's interesting to me, because you just need sort of one market where crypto can actually break through and get through all this regulatory nonsense. So
and why does crypto need to break through? Like, why are you, because you have been a champion of digital. So what is it about coming from the physical world, from gold to the digital world that got you excited? Is it just that the proxy is the same in the sense that, scarcity at some level?
I mean, I think I think Bitcoin has disrupted gold, so that's check. But there's only several million users of most crypto apps on a given day, right? So there's nothing that's really broken through, and we define breakthrough as 100 million users or something like that. So I don't know if it'll get there, Howard. To use the techno talk of whether Web3 will win. I think there's a lot of smart internet tech platforms, the Web2 companies, the Facebooks, right? Will Instagram, incorporate NFTs fully? So it might be a world of 2.5, right? I mean, crypto could just not work in a clean way. My analogy is, I know I sound really old when I say this, but the relational database came out like over 50 years ago. And for database structures, it was super new flexible. But so what, right? It's incorporated by all smart companies everywhere. You didn't have a relational database ETF, right? It didn't become an investment trend.
Interesting, yeah.
So if I had to place my bets, I'm like, those are the risks around crypto, and maybe it's just a 2.5 and the existing incumbents win because they've got the users. So
yeah, I agree with that. There is that feeling I have that this recession is just so good for those Web 2.0 leaders, because the compression that was supposed to happen, we're going to have the next boom right after the last boom, is not happening.
But to answer your question just about Brazil, right? So Brazil, I mean, they have banks that are issuing stable coins that give people interest, like they're in their sandbox. Mm-hmm. But all these things that the SEC is suing about and regulators are fighting about in the U.S. and then, and doing enforcement actions, they're like green lighting in Brazil. So how fast that moves, I don't know. So that's something I'm keeping my eye on. And then, like you say, with AI and all that kind of stuff. I mean, technology it's mind-blowing, right? Every industry, including agriculture, ag tech, right? Yep. Just, what Friedberg's doing, there's just so many different areas of healthcare and everything. It's exciting. It's really exciting.
Yeah, I think there's a misdirection. I think what you said, Bitcoin, for all they wanted it to be, assuming the supply, is limited, it is gold, right? And that's for someone that came up with the gold ETF, like that's a big statement from you. So marginal dollars, you say Bitcoin over gold, do you think personally, or no? You still like gold?
I like both. Okay. I think for a 5-year period, since 2017, a lot of younger investors and a lot of investors were buying Bitcoin based on the story. And now I think whoever wanted to buy Bitcoin has bought Bitcoin.
Correct.
Right. And so now I think that the dream scenario for both is that the Fed says we can't have interest rates this high. The federal government can't afford it. We need to loosen again. And then, gold is sort of an anti-Fed trade. Right. Both Bitcoin and gold should do really well.
Let's go now back to tech, because you and I both have we love tech. The area of tech that interests me is rather boring, but I got to go where I think the puck is going is Wealthtech. Governments printed money for better or for worse, and for what isn't lost over this cycle, like this give back cycle of higher rates, where you have these transition trades. There's no better. For years it was about scale and getting the 90% and the Facebooks and the Schwabs. I don't know how you disrupt them at this point, because they just have such big moats and they have so much cash and so much power in government. But, this wealth industry where you could focus on the 10% or, the people that have money seems like to me to be, it's an area where social leverage is heavily focused on. Do you have thoughts about that? Do you like that idea?
I do. I mean, look, I think even though ETFs are kind of a public markets thing, so it's not my area of expertise, but I think the private markets, technology can really make the private markets more transparent and lower cost to transact in. And so that's where I think you guys can add a lot of value. I mean, I think my comment on our whole industry is, we kind of fake it, right? It's going back to the 60-40, kind of mentality, is we don't know what the right asset allocation is. And so, yeah, right now, since 60-40 has worked for so many decades, yeah, it's impossible to disrupt Schwab. What if 60-40 isn't the right way to make money, and you can make money, in your privates and your startup investing, right? Then I think, I don't know, I'm not saying you're going to disrupt Schwab, but I think you can be really attractive to investors. So, yeah.
Well, I think where Schwab snuck in is around this custody, right? If I think about RIAs, they basically have two choices, because with Schwab buying TD, you have Schwab or Fidelity.
Yeah.
And every time I talk to an RIA, I'm not going to name names, every time I talk to an RIA of 1 to 5 billion, all they do is bitch about their host, which is Schwab or Fidelity, right? And I see a lot of VCs trying to back custodians, but, building trust, which, you may hate, the RIAs may hate Schwab or Fidelity, but, in order for their customers to feel comfortable, they got to have Schwab or Fidelity, right? So it's kind of a catch-22. There's another area where we may not get innovation, like you worry about digital. I worry about custody, because they have no reason to be this horrible, but they are. They're not good products. They're not Apple.
But there is a reason, and I think some of your portfolio companies can disrupt this. And the reason is that they were built, the mainframes they use were built, 40 years ago. And what happened is, and I can tell you a story about looking at tickets in the office of, red, pink tickets were a sell and blue, right? Yeah. And then you'd call Merrill at the end of the day and you'd try to say, this is what my total is, what's your total? And it would never be the same, so you'd have to go through ticket by ticket. And so basically mainframes were just automated all the incredible amount of paper and the explosion in volume in the 60s and 70s, right? Mm-hmm. But if you have a blank sheet of paper, you can maybe build a back office system that's much cleaner and more elegant and more flexible. And they can never get there because they're stuck to the old systems they have. So I think technology is possible. Now, obviously, it's a complicated industry and you can't trade all products and build everything. But don't you think that some of your companies can build a new platform that's cleaner?
Well, we've invested around the space, but every day I wake up and I'm like, boy, they really got away with murder, Schwab. And I don't even know if they planned it. They did in a way because they just bought TD. But, I think about companies that are bloated, and we talk about Twitter. I got to think Schwab could fire 80% of their staff and still service their customers. Maybe I'm wrong. I don't know enough about the business, but that is where I am completely laser focused for the next 3 to 5 years. First of all, because I have a little bit of wealth and I don't want them to touch my money. And so it's all about solving my own wealth problems and that of my peer group. And I think in an era where rates are up and you can get paid for bonds, I think people should be paying for expertise. So there was this 10-year period or 20-year period where, Vanguard, in a 60-40 portfolio, why pay any fees? If we've optimized what you should be allocating to, you might as well optimize in the fees. But now that that's kind of now we're all got to readjust it. I think people optimizing for fees are doing it wrong. So I feel it's an exciting time for certain sectors, but boy, the incumbents, for whatever reason, have got moats that are going to be very tough. And a lot of it isn't just the moat of tech and size. It's the moat of trust and regulation. And just like you said, how do you, even if you build up trust around a couple feature sets or a couple of, markets, how do you get the breadth of offerings that your customers need, especially wealthy ones? We've had the first generals, attack, the Robin Hoods. There's just not that many of the PayPals, the Squares, but man, it's hard to make progress. If I really look back, Jan, and you've been doing fintech too, we just haven't made that much progress. It's still Goldman and JP Morgan and Schwab.
How am I arguing your book? But I'm about to. Okay. The thing is, it's all been in one economic environment where interest rates have been falling. And basically, if you threw money at the markets, you made money. But people at the end of the day, all they really care about is performance, and they're going to be looking at their statements. And it's not happening now. I think people are pretty happy with their portfolio still and, stay invested in the markets. But at some point, they're going to just get frustrated, and they're saying, wow, I am not making money. I'm, in fact, losing money. And
Right.
I can lose money myself. And so I think, listen, people probably will do some investing themselves. Like even you went to cash, right?
Right.
If you take some time as an investor, as a do-it-yourself investor, maybe you keep some with the platforms that are doing the 60-40 thing, but then you want to have a little bit more flexibility yourself, right? And do that investing. And that's where I think, you can offer services to those type of individuals that want to get away from just the 60-40, because if they don't give you those returns, then investors will be open to your offerings.
I appreciate that. You have a sizable risk appetite. So how do you, like you liked us, you invested with us. What is it about us or you invested with another firm, Cadenza? What is it that you're looking for? I'm not fishing for a compliment, but you're welcome to offer.
I know you may want to walk away from this one, but you and I were talking about a deal that you were looking at. I won't mention the company, but I really didn't like it. It has nothing to do with ETFs or anything, but I didn't like it because of, it had to do with proxy voting and stuff like that. Mm-hmm. And you and I circled back a couple of months later and you said, listen, we didn't do it for the fund, but I put some money in there personally because I wanted to stay in touch with what they were doing. And that was, to me, such the right thing to do, which is, have a very broad radar screen to see what's going on, but to be very careful about your client's money. And then also, you guys weren't trying to be the biggest, maybe you were, but you weren't trying to be the biggest VC fund in the world. And I really think that for a lot of investing, it's diseconomies of scale, right? For ETFs, the more money you manage, the lower you can drive fees, the better it is. But for hedge funds and VC, you just don't want to be too big.
Yeah, we started this emerging manager fund based on the same premise. It's like, okay, we know where our max is, $100 million. We can write $1 to $2 million checks. We don't want to be a price taker. We want to be a price maker. The only thing that's changed about our business is we don't need 10, drag along. Even if they add tremendous value, we know enough about what we want to do. We have conviction. We write the check. We don't need anybody to be convinced for our first check. We love that zone. We love that lane or whatever you call it. And in building that expertise over 10 years and luckily having the returns, we're not sure if it's just all market related or picking or, we like to think it's picking. We think in everything that we've learned and all the things that institutionals told us when they passed on us and all the reasons that certain people cherry pick the wrong things from within our portfolio when it came time to doubling down and tripling down, that we would take what we've learned and just become those people that we despise for not investing with us at the first time. So we set up this emerging manager fund along those same lines. So I think we have figured out a little area of the world. And as you've done in ETFs, there's a lot more under there. Once you get into it, there's a lot more there. And so applying it to ETFs, where are we in the ETF world? Where is the boundaries of what ETFs are? Is there something new that fascinates you that's better or different than ETFs?
Oh, that was a great pivot.
Yeah.
I don't think, it's a maturing industry. There's a lot of competition. It's been hard for many years to come up with a new breakthrough idea. So a lot of it is just explaining to investors what fits in which market environment and, what your thinking is behind the particular ETFs. I think they continue to be a growing part of people's portfolios, though, because they're so liquid and they're so transparent, and they're a great way of, solving a lot of portfolio needs. I have spent a bunch of time. We launched our liquid token fund a couple of months ago, so talking to investors, and it's stunning to me how in love they are with private equity and venture capital, and they're totally illiquid parts of their portfolio, Howard.
Yeah.
I mean, I won't mention the group, but I was with this huge pension funds, and I said, how cheap do public markets have to get before you would actually buy them? And you know what they said? We won't buy them under any circumstances.
Yeah.
That's insane.
I don't think they're right. I think the pensions worry me the most, not the UK type of pension problem. I had Ben on, we were talking about this. I feel they're over allocated now to the Andreesens and the benchmarks and the
They've
insights.
never been so long equities.
Oh, equities.
So
I thought you meant private.
Yeah.
I think they're long.
No, but I
venture.
include privates. I include privates as part of equity.
Yeah,
so if you add their privates and their publics, they've never been this long equities, and they can't pivot.
It can't pivot. There's no liquidity. I would not call on a pension anymore because I know that if they're being honest, they're going to say, we got so much exposure. We got lucky to get out of Uber and Airbnb in that window of a couple of years ago, but that window is shut. So they could be looking at 5-10 years. If the IPO market stays shut for a few years, they are so overexposed to the Andreessens and Insights in these large venture funds. So I worry. I don't know if that's like a crisis. It's just they're stuck.
Yeah, but for us, individual investors, right, it's a sign that we should be looking at the public markets because either you buy them through an ETF. There's so many stocks, so you're forgetting the tech stuff, that are less than 10 times forward earnings and with pretty good businesses, right? So over time here, we can cherry pick into those markets, I think, in a way that a lot of institutional investors can't.
The Dow had its best month ever. And like you said, pensions are worried about what's happening in the UK are they're probably going through their portfolios and go, what, did the bankers screw us somehow? Well, we weren't looking. And then they're also realizing that they gave their money to these gigantic VC funds that they don't really have much edge when you put that much money to work. Giving a founder $300 million at $1 billion valuation to say, go figure it out with our $300 million is not really a startup. That's just really high risk asset allocation and hope. So I do think they're a problem in the market. I think we've covered a lot. Is there anything I missed about VanEck?
No. But just to finish, I just think the next couple of years, just don't rush into it. But I think dripping into the public markets are just going to be a lot of good companies to buy. So that's what gets me excited. Just don't be in a rush. That's kind of my only theme about it. And with the debt stuff, obviously, if that starts blowing up, you need gold and Bitcoin. But no, it's been great talking to you guys.
Yeah, the VanEck offices are in Florida and New York, correct?
Yeah, Tampa and New York, but mainly New York.
All right, buddy. Well, I know you're interested in podcasts. What are your two favorite go-to podcasts? Not to embarrass you.
All in, which is a little bro-ish, but
and what do you like about it? I know what I don't like about it. What do you like about it? Well,
I know what I don't like about it, but I'm not going to go there.
Yeah, but what do you like about it?
I think Chamath is, regardless of whatever, he's brilliant at simplifying and synthesizing what's happening in the public and private markets in particular, just to call him out. And I just think the back and forth, like the discussion about individual deals, like when Adobe bought that Figma. Kind of Figma. I mean, great discussions about like a business case, right? From all the different angles that you don't always hear, and you can't read about easily. So that's what I like about that.
Yeah, no one's doing that. I talked about it with Ben Hunt and Jim O'Shaughnessy, and I'll tell you, we've been talking about that kind of type of podcast for the macro world. Would it work? Is there enough people out there?
I like the mix. I think you need macro, but I would also want to cover some individual stocks.
Oh, no, markets. But I agree, yeah, like macro and the markets.
Yeah, not just macro talk.
I meant like macro as it relates to like all kinds of markets like you and I talked about today. I think there is a place for that now that they've uncovered that there's a much bigger market for discussion about making money, I guess is what you would say. There's definitely room now in this culture for the same thing to be about public and private markets. So definitely thinking that through. So I'll pick your brain offline on that. But man, what a treat.
Can I mention the other ones?
Oh, yeah, sorry.
So I don't really have a second one, but I do listen to Josh Brown. Empire, which is a Blockworks crypto podcast, I think is like a kind of a must listen. And then there's a really weird, not weird, but very niche podcast called Boardroom Governance, which, people talk about ESG a lot, and that's just about, interviews with board directors and things like that. That's very niche, but those would be the other ones I'd mention.
Okay, well, that just that dropped you down a few notches. Like, now, do you listen to that in like a robe with a pipe? Like, where do you listen? How do you listen to a boardroom governance thing? What is VanEck doing? Like, what? Well, that is what makes you unique.
I just let my inner law school student come out, didn't I?
But you know what?
I should have kept that away.
Knut and I are having such a ball with this. It's not, we don't have the hundreds of thousands of listeners, but we definitely have the tens of thousands. It's so good for the podcaster. Like, I like to write, but I love doing these. And, I've decided, I took some time off. I just decided I'm just going to have friends on. Like, it's very hard for me to do these things with anybody but friends, because I want to be able to talk about a wide variety of things and stay on my topics. So I'm going to stay even more selfish in kind of what I'm doing. But all right, so what was the crypto one?
Empire.
Okay, so Empire
from Blockworks.
From Blockworks. Yeah. All right, my man. I look forward to following up on this, but I think you gave some great insights. People need to be thinking about the markets here just in a little different way than what worked in the past. And like I said, the Dow had its best month ever, last month. So it's not like stocks can't go up, but it's not going to be the same. So a lot of interesting things going on. Say hi to the fam. The kids seem to be doing great. And I will see you soon.
Thanks. See you on the other side, Howard.
K-Nut.
Hey, Howard.
So what do you think?
He's another one of those extremely smart, eloquent guys.
Yeah, I tried to get him to joke around, which is what we generally do when I call him after I hang up here. But you can't pass up having that information.
You got him snickered him a few times.
No. I mean, just the 70s. Like, he's a history buff, and like there were at some point in time where you need to draw back on some old things, and I don't have those things to draw back on. So it is good to hear that as worried as he is about the macro. I think he said it himself. We don't know. Like, the governments have been doing this for way too long for us to know where it cracks. But some good ideas that he shared about how to think about investing. You are listening to Panic with Friends. Knut and I, once a week, sit down with a great investor, thinker, entrepreneur, trader, venture capitalist, and talk about where the markets might be heading. Try and get a little bit ahead of the curve, not too far. You can go to Spotify, Apple, search my name, Howard Lindzen, or Panic with Friends. You subscribe, click the button, boom. You don't have to do anything. You will get an alert and catch a fresh show every week. Thanks, Knut, and we'll see everybody soon.
Howard Lindzen is the founder and general partner at Social Leverage. All opinions expressed by Howard and podcast guests are solely their own opinions and do not reflect the opinion of Social Leverage or Stocktwits. This podcast is for informational purposes only and should not be relied upon for decisions. Guests may maintain positions in securities discussed in this podcast.